So just to very briefly summarize what we know so far from the previous few lessons in the technical analysis module, a bullish trend or bullish order flow in the market, it is shown by structure forming a series of higher highs and higher lows. So therefore a bearish trend or bearish order flow in the market is shown by structure forming a series of lower lows and lower highs. And whenever price breaks structure, we then expect what? We expect a pullback on that time frame. So then we looked at the concept of strong and weak highs and lows, which is also based on the idea of expectational order flow. So a strong low is a low that caused a high. So if a swing low actually does its job by taking out a swing high and causing that break of structure, if that low causes the higher high, then we assume that is a strong low and it will now be protected because it took a lot of money in order to break that high. So now there is a vested interest in those institutions, right, that they do not want to see that low break because they do not want to be stopped out of those positions. So it is these strong swing lows are what make up the higher lows in a bullish trending market, and it is those higher lows that we are trying to catch and position ourselves in long to capitalize on that next bullish leg. And once we are in that higher low, we are then going to try and target price to make the next higher high. So we're targeting that weak high being broken to form a higher high. So obviously the exact opposite to that is a strong high, and these are highs that did their job by causing lows. So if a swing high does its job by taking out a swing low, then we can assume that is a strong high, and that high will be protected. And these strong swing highs are what make up the lower highs in a bearish trending market. And it is those lower highs that we are trying to catch and position ourselves in short to capitalize on that next bearish leg. And we're trying to target price to take out that weak low, right, to make the next lower low. Now price can pull all the way back up to that swing high, that lower high in a bearish market, but we run with the assumption that price will not trade higher and it will not close above that swing high because it is a strong high, and in theory that high should be protected to keep the bearish trend intact. However, eventually a strong high or a strong low, it will of course be broken because trends do not last forever. So a change of character is when we see a failure of expectational order flow because bullish structure starts changing to forming bearish structure, right? And vice versa. So if price is trending to the upside in a bullish market, and then we see that a swing low, so what a strong low then gets taken out, so that we see a swing bust, a swing break of structure to the downside, then this first break of structure is defined as a change of character, and we now have a confirmed bearish trend change because price has formed a lower low after a series of higher lows. However, price can also just break minor structure, so an M-boss, or substructure, so an S-boss, and this can also be viewed as an internal change of character. So a minor or substructure break, it can signal that a swing run has ended and that the swing pullback has now started. So then it can also signal when that swing pullback has now finished and the next swing run may be about to begin, so that we can anticipate that the higher low in a bullish market may now be forming, or a lower high in a bearish market may now be forming. So this can obviously help us with our trading decisions. But because minor and substructure breaks are not as significant as swing structure, this means that changes of character based only on M-bosses or S-bosses, they can give us false signals. It can give a false signal that a swing run has ended or that a swing pullback has finished. So what we can do is use other concepts, techniques and tools in our analysis toolbox to help us build more confidence and more evidence to increase our ability to stay out of trading those false signals and those traps in the market. So in turn, actually increasing our strike rate on catching the true turning points and the true continuations in the market. Now, one of those tools that we just looked at in the last lesson was the concept of premium and discount pricing. And we can see that waiting for price to pull back into discount prices in a bullish trend will lead to a higher probability of that change of character being a true signal that that swing higher low has actually formed. And obviously, if price was in a bearish trend, it would be the opposite, right? So we'd be waiting for price to pull back into those premium prices that will lead to a higher probability of that change of character being a true signal that the lower high, the swing lower high, has actually formed and that the bearish trend is ready to continue. Now, in this lesson, we're going to add an even more powerful tool to our toolbox by harnessing the power of market structure by looking at multiple timeframes together. So multi-timeframe analysis is pretty much what it says on the tin, right? It's when you analyze multiple timeframe charts together. So using multiple timeframes in conjunction with each other is pretty much like seeing a completely new dimension of price action, which can dramatically alter your perception of the data. So when you master this, you will significantly improve your trading returns because you will improve both your strike rate and the average risk to reward that you can actually achieve in the market. So multiple timeframes gives you the whole complete picture compared to just using one timeframe, which is what we have done so far. So analyzing multiple timeframes effectively, what it's going to do is it's going to give you that time to enter a trend just as it's about to begin, so you can get right in at the start, but it will also provide the indication that you maybe need to exit your position just before that trend or that run is about to come to an end. So developing the skill is going to really allow you to capture those huge higher time frame moves, potentially those weekly or even monthly runs, but you are entering with the accuracy and the precision of timing your entry on the intraday timeframes, those lower timeframes, even all the way down to the seconds timeframes, and that's how you achieve those huge risk to reward trades. So on the weekly time frame, one weekly candlestick will contain the price action of 5 daily candlesticks, 30 4-hour candlesticks, and 120 1-hour candlesticks. So obviously one daily candle will be made up of 24 hours worth of price action, and so on. So you can clearly see that as you start from those higher time frames and then you work your way down and down, going lower will give you more price action, which is going to give you more information, and therefore is going to give you more confirmation. So you can be extremely accurate with your entry points and your analysis, but whilst making sure that you are still trading with the overall higher time frame bias, and you're still trading with the dominant trend of the higher time frames on our side. So time really is power. Now, the longer that a setup has to marinate, the more powerful and delicious the move will be, right? It's a bit of a horrible analogy, but that's essentially kind of how it makes sense in my head. So essentially the more orders and liquidity that have been stacked over time to then fuel that large move. So for this reason, analysis on the higher time frames always takes precedence over analysis on the lower time frames. So the monthly time frame is more significant than the weekly time frame, the weekly is more significant than the daily is more significant than the 4-hour more than the 1-hour, right, and so on, all the way down to the minutes and the seconds time frames. So this is why we always take a top-down approach. So we always start analysis on the higher time frames to develop our higher time frame bias, and then we slowly work our way down to refine and increasing our timing accuracy. Now, the higher time frames are not necessarily a specific time frame. It is just any time frame that is essentially higher than the one that you are looking at. And the same goes for the lower time frames, and it's going to be different for every trader depending on their own unique trading style. Now, the reason that we use candlestick charts in our analysis is due to their unique ability to condense a vast amount of information into a small, neat, and manageable graphic display. So by analyzing what is essentially just a colored shape on your screen, you can interpret tons of stuff. You can interpret direction, acceleration, deceleration, strength, weakness, choppiness, where there's supply, where there's demand, and where there is liquidity, amongst many other things within the market, all just from analyzing candlesticks on a chart. But the paradox with candlesticks, however, is that their greatest strength is also their greatest weakness. Because by condensing a large amount of price information into a manageable visual display, those candles lose a lot of important data that occurs within the lower timeframes. And it's this data loss that can often cause misleading signals or fail to provide a signal when necessary. So you can kind of think of candles as representing the tip of an iceberg. So while they provide a really excellent sign of what is ahead, there is a lot more that lurks beneath the surface. So for the most part, the exposed tip of an iceberg is enough for the captain of a ship to, recognize the need to steer around it. But every now and then, an iceberg will remain fully submerged below the water and provide no indication of its existence above the surface. So without peering below the water, the captain is likely to steer his ship and crash straight into it, right? So in trading, using a lower time frame is the same as peering below the surface. And the more time that you spend in front of your charts, the more you will really realize that all of the time frames are very intimately connected to each other. So when price is trending, right, we've seen this a million times now. In this case, a bullish trend, price moves up, it pulls back to form a higher low, and then it breaks structure again to the upside to form a higher high, and so on. Now, each of these movements up and down are called runs. So price impulses up, and then it corrects back, and then impulses up again, and then it retraces back, right? And that is the heartbeat of the market. Now, collectively, all of these runs together make up what we then call a trend. Now, are you ready for what is the major key in unlocking the secrets to understanding and harnessing the extreme power of multi-time frame analysis? You are? Fantastic. Well, the secret sauce here is that a run on a higher time frame is a trend on a lower time frame. So a run on a higher time frame is a trend on a lower time frame. Sounds pretty simple, right? Well, when you get your head around this and when you fully understand it on the charts, it is when the power of multi-time frame analysis will really start to click, and you will massively increase both your strike rate and your reward to risk ratio at the same time, which is the holy grail in trading, right? Increasing both of those simultaneously. So price action ultimately forms the candles and the price action on the next highest time frame. So we use the price action on the higher time frames to predict the next phase of the market. So whether that phase is a pro-trend run or whether that phase is just a counter-trend pullback, it's those phases that are made up of price action back on the lower time frames. So those higher time frame runs, they are made up of lower time frame price action, and then that then forms the higher time frame candles and market structure, which we can then use in our analysis to help us forecast the next higher time frame run. So that's essentially the cycle of multi-time frame analysis. That is the fractal order flow. So we analyze the higher time frames so that we can forecast those large runs and trends, but we then drop down and then we analyze the lower time frames to not only to help us time our trade entries and our exits with a lot more accuracy, but we also use them to confirm what may be happening on the higher time frames. So this really is essentially the secret sauce of how we achieve the holy grail of a high reward to risk and a high strike rate strategy. So what happens on the higher time frame first must happen on the lower time frame. So let's take a few examples and we're quickly going to go on the charts. So if you are sitting in a dark room with your brightness turned up, my charts are unfortunately white, so just you may want to turn down your brightness so you don't blind your eyes. You have been warned. Okay, so we have seen that a run on a higher time frame is a trend on a lower time frame. So what does that actually mean in reality? Well, as we now know, right, what do we have when we have a bullish trend? We have a series of higher highs. We pull back to form what may be potentially be a higher low, which is then confirmed when we break that high, we break that swing high, we break structure to form a higher high. We pull back to form a higher low. We make a series of higher highs, higher lows, higher highs. And then when that higher low is broken and we form a lower low, that is then when we get a confirmed trend change. And then we pull back to form a higher high, lower low, higher high, and lower low. Now each of those phases, so the pro-trend run, the counter-trend pullback, the pro-trend run, the counter-trend run, they're all called runs, right? Each individual part is called a run, and overall that will give us our higher time frame trend, right? So in this example, the blue line is our higher time frame structure. So again, higher time frame can be any single time frame. It's just higher than the other time frame you will be comparing it to, right? The lower time frame is the one in the orange line. So like I was saying, we have those pro-trend runs, and then there's pullbacks, which also runs, and they collectively make up a trend. And then again, we have the pro-trend run is now bearish, the pullback is a counter-trend run, and that makes a overall bearish trend, right? Now on the lower time frames, that bullish leg, right, where the higher time frame is forming higher highs, it will also be forming higher highs and higher lows on the lower time frame. But because price is fractal, what you will see is price will make higher highs, higher lows, higher highs, higher lows, and higher highs. Now, as the higher time frame wants to have a pullback, right, what may happen, depending on what lower time frame you're looking at, is the lower time frame will switch trend in order to facilitate the higher time frame to pull back. So then you see that we take that low out, right? We get that first change of character where the lower time frame then switches bearish. We get a confirmed lower low, lower high, and lower low. However, that bearish trend on the lower time frame is reasonably short-lived. Why? Because the higher time frame is bullish and it was just a pullback, right? It was just a counter trend higher time frame pullback whilst the lower time frames were bullish. Now, when we expect a higher time frame higher low to form, what do we expect on the lower time frames to give us confirmation that this may be forming? Because remember, a higher time frame or a low on any time frame, right? So a higher low is never confirmed until we get that break of structure. So we never know where it's going to be, but what can we use to potentially confirm? We can look for a change of character, but more specifically in this case, we can look for that change of trend on the lower time frame, the orange line here, where we get that higher high, we get the pullback, and then we get the higher time frame break of structure, right? And we continue to form that series of higher highs. And then again, price starts to end the higher time frame run. After the higher time frame break of structure, what do we expect? We expect a higher time frame pullback. Now, what can the lower time frames do? It can then change trend to show or confirm that the higher time frame pullback is now commencing. So the lower time frame now switches bearish, lower high, lower low, lower high, lower low, and then it switches bullish again, giving us a signal that the pullback may be over, the higher time frame pullback may be over. The lower time frame now switches trend to switch bullish again, giving us an indication that the next higher time frame pro trend run may be happening. So now we can target that week high, right? Whilst the lower time frames remains bullish until we get all the way up here. Now, what can sometimes happen, right? Depending on what, how big of a gap between the higher time frame you're looking at and the other lower time frame, is that when your higher time frame starts to pull back, the other lower time frame that you're looking at, it doesn't always have to switch bearish, right? Because sometimes you could have quite a big swing move up on that lower time frame. And then when the higher time frame starts to pull back here, you will see a substructure lower high and lower low, right? This is a substructure break. But at that time, this is the swing low. This is the higher low on the lower time frame, and that is the higher high. Now, when the higher time frame pulls back to form a higher time frame higher low, right? This low here on the lower time frame is never breached. So actually, they both stay bullish this whole time, but you just see that substructure break, and then you see that minor break of structure, and then it switches bullish again, right? And we get that high, right? So just kind of want to drive that point home there whilst I delete some of these drawings to clear up this all up, is that we expect the lower time frame to change trend, right, in order to facilitate a higher time frame pullback, but it's not a hard and fast rule, right? Sometimes it's not always going to switch bearish in order to do that, especially if the time frames are reasonably close. So imagine our higher time frame in this case is the 4-hour chart, and the orange line, our lower time frame, is the 15-minute chart. That's not a massive gap between those two time frames. So a lot of the times you will see that you'll get a 4-hour pullback like here, and the M15 will never switch trend either. Okay, so sometimes that will happen, right? And then we move up and we form a higher high on the higher time frames, right? And then this is again where potentially, right, we're going to obviously look at more confluence as we learn more concepts as we go later in the course. But just to get you thinking, let's see, we see a big higher time frame level up here, big supply zone, and we are anticipating that potentially the higher time frames, the 4-hour chart, may reverse and the trend may end, and we may get a lower low. So we want to be aggressive. We don't have to do this. We could wait for the 4-hour to switch bearish first. We could do, but maybe we want to be a bit more aggressive and we want to anticipate that the 4-hour is going to reverse. What we can do is drop down to a lower time frame. So let's say the 15-minute chart, and we can wait for the 15 minutes to switch bearish. So when the orange line takes out that higher low to form a lower low, and we get that bearish trend change, at a minimum, that can signal that the 4-hour pullback is starting, right? Because we can still expect a 4-hour higher low at this point, right? Because we expect this to be a strong low because it took out the high. So when we get that 15-minute change of character and the 15-minute switch is bearish, at minimum, we can expect the 4-hour chart to pull back, but we are also anticipating that potentially we may get that 4-hour break of structure. So the point here is that if you're anticipating a higher time frame reversal, you can wait on the lower time frames to wait for the lower time frame to switch bearish first. So when we take out that low on the lower time frames, we are now confirmed bearish on the lower time frames, right? And we can position ourselves short with the anticipation that potentially this will break, but of course it's not confirmed until we get that movement there. Now, when price is then bearish, let's say in the M15, and then price switches bullish again, showing us that now the 4 hour is likely to pull back to form that lower high, right? And now when is that pullback going to be over? Well, the M15 is going to switch bearish again, right? Now we can have confidence that the lower high may be in place, right? It's never a guarantee because the M15 could switch bearish and then it could switch bullish again and we could have a deeper pullback. It may want to come up higher, right? And then it could switch bearish again, right? The M15, and now the lower high could be in place. But we're just trying to stack probabilities in our favor. And one of the concepts that we use, right, is changes of character, looking at multi-time frame analysis, waiting for that to switch bearish, and now that can give us an indication that potentially the 4 hour lower high is in place and we are now ready to run this low. So now you can really kind of see that fractal relationship, right, with the time frames, where what will happen on a higher time frame, so this switching bearish or this run, pulling back, it's going to happen first on the lower time frame. So you're going to get that bearish trend change, and then the 4 hour will potentially switch bearish. Okay, so yeah, hopefully that makes sense. This is quite a reasonably simple and clean diagram, looking at just two time frames together. But let's take a look at a slightly more complex example. Okay, so this diagram is a little bit more messy as there's a little bit more going on, but let's just slowly go through it and see what we have here. So this time, instead of just looking at 2 time frames, we have 4 time frames, and we have them as the daily, the 4 hour, the M15, and the M1. But again, this is not time frame specific. This can apply to any set of time frames that you wish to view it just as long as they are in time order. Okay, so what I mean by that is this could be your monthly, right? This could be your daily, this could be your 4 hour, and this could be your M15, right? They just need to be from the higher time frame, and we work our way down. But in this case, let's keep it simple, right? The grey line is our daily time frame. So as you can see it here, it's kind of faded at the back, but we have a daily higher high. The daily then pulls back, and then we have the next daily pro trend run there. Now, as the daily moves up, right, as we've just seen, what would that be on the 4 hour chart? That will be a series of higher highs and higher lows on the 4 hour chart, right, as the daily makes that run. Now, what can give us an indication that the daily is about to switch bearish? We get a lower low, right? The 4 hour switches bearish, we then get a lower high, and then we get a lower low. Now, what can give us an indication that the daily higher low is in place? We can see the 4 hour switch bullish again, right? So it doesn't quite switch bullish straight away, right? But then it switches bullish there, and now that can give us an indication that potentially the daily higher low is in place. And now potentially we're going to get that break of daily structure, and we're going to get that daily high, and the 4 hour continues bullish, and then finally we get that daily break of structure, and we continue on making higher highs and higher lows, right? So that's the relationship in this case between the 4 hour chart and the daily chart. But what do we also have within those 4 hour runs, right? That's a run, that's a 4 hour pullback, which is a run, that's a run, that's a 4 hour pullback. Within each of those runs, right, a run on a higher time frame is what? It's a trend on the lower time frame. So that 4 hour pro trend run, right, that one move up on the 4 hour chart is made up of a series of higher highs and higher lows on the 15-minute chart, right? We have that trend within there. Now, when that 4 hour pro trend run, that higher high comes to an end and it pulls back, right, that counter trend 4 hour pullback, what happens? The M15 breaks a low, it forms a lower low, and it switches bearish, right? And we come back. Now, when that 4 hour higher low is likely to be in place, what is going to happen? The M15 will then switch bullish. We'll get a break of structure, that change of character in the M15, and we'll move up, so on and so forth. And then we'll break that low, pull back, break the high again, okay? So you can see that the M15 trend makes up the 4 hour runs, right? And that 4 hour trend makes up the daily runs, okay? So on and so forth. So then you can start to see how you're piecing those 3 time frames together to really give you an indication. So like I was saying, right, when we look at the grey line, the daily line, and we have price forming that higher high, now, what can be the first indication that the daily pullback is going to occur? Well, the one that we looked at is to wait for the 4 hour low to switch bearish, which is, right, the 4 hour is the green dots, the bullish trend, right? Then it comes down and we get the red dot here because we get a 4 hour lower low. So that then confirms that the daily chart potentially is pulling back now, and we have a higher high here on the daily chart, right? But how could we potentially get even earlier? If we were a bit more aggressive, is we could look at the M15 and we can go, okay, the M15 has broken structure to the downside, which tells us that the 4 hour may be pulling back, Now, potentially the 4 hour we can anticipate is going to switch bearish, and because we think that the 4 hour may be switching bearish, then we can anticipate that actually we're going to get a daily pullback. So that means that we'll see a sustained 4 hour daily trend. And we saw that first on the M15, right? The M15 told us when it formed a lower low that the 4 hour was going to pull back. And when the 4 hour switched trend and broke that low to form a lower low, that told us that the daily was pulling back, right? And the same thing here. The first thing that happens is the M15 switches bullish, which gives us a sign that potentially we're going to get that 4 hour counter trend pullback, right? Because the 4 hour is bearish at this point. But the M15 had to switch bullish to give us that first sign, right? And then when the 4 hour came up here and broke that 4 hour lower high to form a higher high, that then tells us that potentially the daily higher low is now finished, the pullback is over, and we are about to switch bullish and get that break of structure, right? But it all happened on the M15 first. The M15 is your first potential indication that everything above is about to switch, right? So on and so forth. So this kind of circle here, where I've just kind of essentially view this as a magnified section of price action, right? So if we were to essentially just carve this bit of price action out and then zoom right into it, what we can see is just part of that daily leg, right? That one daily leg is that grey line. That one daily run is made up of what? It's made up of a 4 hour trend with a series of higher highs and higher lows. Those 4 hour runs, that single run there, that pro trend move, is made up of a trend on an M15 time frame, the orange line. When the 4 hour wants to pull back, the M15 will most likely switch bearish until it's finished its pullback, then it will switch bullish, right? And then the 4 hour will continue. And all of that is just part of one daily leg. So the 4 hour is bullish during the daily leg, the bullish daily leg. The M15 is bullish during the 4 hour leg, then bearish, and then bullish again. So it switches trend multiple times in just one daily run. And then what do we also have? Within the M15 single run there, right, that pro trend 15 move, the dotted line here is the M1, the 1 minute chart. So that 1 15-minute move is made up of a multiple series of higher highs and higher lows on the M1. When the M15 is about to pull back, we get a break of structure on the M1 switches bearish, and it has a trend, right? So on and so forth, right? Hopefully you're really started to see how all of it is connected and it all does the exact same thing, except just the lower time frame you go, the quicker it happens. So this is why it all comes back to this very simple sentence, that a run on a higher time frame, right, that one straight move is a run, that one straight counter trend move is also a run. But those runs are made up of trends on a lower time frame. So that lower time frame trend essentially has to change for that pullback to occur, right? And then it changes again for that pullback to go. And then the more you zoom out, the more you'll see. So, right, if you were to kind of copy and paste this whole section of price action, right, multiple times up above, right, and we had the daily chart going on like this, and then you have all of the moves within that, right, and then you have that's all the 4 hour chart, very horribly drawn here, and then within that you got the the M15, right, making all of that all within there, and then you'd have the M1 all within that, right, and you have this continuing. Then what would that be overall? On the monthly chart, you would see one line up, one pullback, and one line up, right? And that's just the fractal nature within the fractal nature within the fractal nature of everything that is going on there. So let's take a look at kind of one last example, theoretical example on the charts, just so we can kind of start to now piece together a bit more how we can kind of base a trade idea around this concept. So this particular sort of line chart diagram of price action you should be getting pretty familiar with now, right? We're kind of building upon this exact same example each lesson now with each new concept that we learn. So let's slowly go through this with everything that we now know about the fractal expectation of order flow, and that a run on a higher time frame, right, is a trend on a lower time frame. So we always start on the higher time frames for our overall directional bias, and then we work our way down, right, for that timing and increased refinement. So in this case, the 4 hour chart is bullish. We have a series of higher highs, higher lows, and then we get that break of structure. What do we expect after a break of structure? We expect a pullback on that time frame. So because this is a 4 hour time frame, we expect a 4 hour pullback, right? Now, once we start to see price pull back on the M15 time frame, so in this case the M15 is the blue line, right? If there was, say, a minor M15 low here, price would then break that low. We would see that minor break of structure on the M15 to the downside. That can then give us a signal that perhaps the 4 hour swing run is now over, right? Because we have seen that M15 change of character, right? When we get that substructure break here as well, confirming now that the M15 is bearish, right? We have a bearish trend on the M15, the blue line, to show us that the 4 hour chart may want to pull back. So now the M15 has changed character and the M15 is bearish. The 4-hour chart is now likely pulling back. We can expect price to pull back below the equilibrium, right? Below this red line, which is the equilibrium of this swing move. So down anywhere into the discount pricing. That is where it's most likely, or the highest probability, doesn't have to, right? But most probability where price will pull back on the 4-hour chart. So looking at the M15 bearish trend, right, we can see it forming a series of lower lows and lower highs, right? And then we can mark out the premium and discount of the M15 trend as well if we want to take these trades, right? So this would be pro M15 trend because the M15 is bearish, and we can take those kind of short-term intraday trades in the direction of the M15 trend, but we have to be aware that it is against the 4-hour trend. So although we are pro M15 and we can be looking for shorts, we have to be aware that this bearish trend is probably not likely to continue that long. And as soon as we start to get down towards sort of the discount of the 4-hour bullish leg, right, it's becoming lower and lower probability to be looking for shorts, because at any point in time, that 4-hour higher low could kick in, right, and we could then start that next swing run to the upside. So when price has now pulled back into the discount pricing, right, so as I was saying, there's an increased probability that the 4-hour higher low, right, may form. Now, we don't know when or if the 4-hour higher low will form. It's just our expectation, okay? The M15 could stay bearish the whole time, right? And it could break this low, and then the 4-hour would then be bearish, right? But until that happens, we run with the assumption that it's more likely and more probable that a higher low will form. Now, to give us increased confirmation that a higher low may be forming, and that we're not just going to continue and reverse to the downside on the 4-hour chart, we can wait for a bullish M15 change of character to occur, right? We don't have to, but right now I'm just talking kind of about a really high probability example, okay? We'll kind of get into more advanced ways in which we can get in much earlier, but for now we're just looking at kind of this I guess high probability utopian example in the markets, okay? Just so we understand the concept. So the M15 is bearish. We're now in the 4-hour discount of the bullish leg, and we are waiting for the M15 to switch bullish again to confirm that the higher time frame intentions are true, and that we're potentially going to get that 4-hour higher low to then target that next bullish swing run. So now that we get that change of character, that after a series of lower highs and lower lows on the M15 chart, the M15 chart now switches bearish. Now, we don't just want to buy straight away. Of course you can, but we want a little bit more increased refinement for that. So what do we expect after an M15 break of structure? We expect an M15 pullback. Now, how far is that M15 pullback likely to occur? Well, we never know for certain, but we can use the premium and discount of this 4-hour leg, right, to look to buy within the discount prices to increase our probability, to increase our strike rate, and increase our risk to reward. So when price is pulling back, what can we do to give us an indication that the M15 high low may be in place and the M15 and the 4-hour leg is about to, get that next bullish leg? We can drop down to another lower time frame, and in this case the orange line is the M1, right? So we're just dropping down again and again to give us more indication, to get all of these time frames in sync, to give us that extra confirmation that everything is about to happen, okay? So in this case the M1 is bearish, right? For the M15 to pull back, what's going to happen? The M1 is going to switch bearish. So we're in a bearish trend in the M1. So then we wait for price ideally to pull back into the discount of the M15 leg, and then we wait for the M1 to switch bullish. So when we get that change of character on the M1, when we get that minor break of structure, that can now give us a good indication that potentially the M15 higher low is in place, right? Confirming the 4-hour higher low. Now we can what? After an M1 break of structure, we expect an M1 pullback. And then we can wait for the M1 to pull back into the discount of the M1 leg, right? Again, giving us even more confirmation, extra refinement. That can now be our first M1 higher low, confirming the M15 higher low, confirming the 4-hour higher low, confirming that the trend is going to stay intact. And now all systems are go to now target the weak 4-hour higher high, right? This would to target the weak high because it never took out the low. So in theory, this should be weak. And now we had all the confirmation, all the time frames are now in sync. And this is a very, very high probability area to then look for that swing position with M1 or even, 15 second, potentially even 5-second refinement, right? Which we're going to get into. And you have now just used all of that to get insane refinement, insane confirmation to capture the 4-hour leg and potentially further, right? We could be at the bottom of the start of a daily trend. And that is essentially the secret sauce of how you achieve these high risk to reward high strike rate trades where you wait for all time frames to be in sync, and then you target those higher time frame expectations of where you see price will go. So hopefully it's all starting to make sense. Hopefully it's just starting to click. Now we'll just go through a few more things, and then we'll hop on the charts after this to show you how this actually looks in reality and price action. And really just start to get a lot of practice so we can get very, very familiar and comfortable with it. So as we have clearly seen, price is fractal. What happens on the higher time frames must first happen on the lower time frames. Now when we are mapping our structure on the charts, I would highly recommend that you use a set number of time frames to do so. Now the reason why is because if you start flicking through an endless amount of sort of different time frames, you can end up just fitting the price action to the narrative that maybe you want to see, and you'll most likely just end up getting thrown about by the markets in the long run. So if you want the best possible chance of achieving consistent results in what is ultimately a random game, then you need to be consistent in the variables that you have personal control over, right? So I'll give you a kind of general example that is kind of based more on my own current personal trading style. So I use the daily time frame to give me my overall higher time frame perspective. Now I will also look at the monthly and the weekly time frames, but I will only be looking at those once a week really, because the price action on those time frames and the market structure on those time frames, they're not really going to be changing that often, right? The monthly and the weekly are going to take weeks and months to sort of play out and shift. So I'll then use the 4-hour time frame to give me my overall narrative. So this is where I really start to build the story of price action. And then I'll drop down to the M15, the 15-minute time frame, to give me more of an immediate bias. So essentially that's the direction that I want to be trading in. That's what I use the M15 for. And I'll drop down to the 1-minute time frame, and sometimes lower. So sometimes I'll use the seconds time frames to just give me that extra timing that I need to execute my entries. So essentially the way that I use the daily time frame is to show me when is the 4-hour trend likely to turn around. So if the daily is on a bullish run, right, and it breaks a daily high to form a higher high, what do we then expect? We expect the daily to pull back, right? So the daily time frame is then telling me that the 4-hour chart is likely and potentially to switch bearish soon, so that the daily chart can then start its pullback, right? But then because I'm only expecting just a daily pullback, I can then know that the 4-hour bearish trend is probably not likely to last very long, right? Because it's just a daily pullback. So then when I analyze the daily and I think that it has now pulled back to an area of fair value, where the daily high or low is likely to form, I then use that information to tell me that the 4-hour bearish trend is now more likely to end, and then the 4-hour is likely to switch bullish again to continue the daily bullish pro trend run. So that's how I use the daily chart for market structure. It's mainly just to help me see when the 4-hour trend is likely to turn around. So then when I'm looking at the 4-hour chart, I'm essentially asking myself, whether the 4-hour is in a continuation phase or if it is in a counter trend pullback phase. And then that will then determine how aggressive or conservative I will be with my entries and with my management, depending on whether I will be trading against the 4-hour trend or if I'm trading with it. I will then use the M15 to give me confirmation of when the 4-hour continuation phase may be ending and the counter trend pullback may be starting, and vice versa. So I also use that to show me when the counter trend pullback is finished, right? When the 4-hour pullback is finished, the M15 then switches trend again to show me that the 4-hour continuation run may be about to commence. And then finally, the 1-minute time frame, and sometimes lower, is then used for that last extra bit of timing to confirm those turning points in the M15, right? And this is where I will then look for my entry models to enter my positions. Okay, so the 4-hour and the M15 for me personally, just those two timeframes alone are probably where I spend over 95% of the time looking at and analyzing when I'm on the charts and just looking at the market. I will only drop down to the M1 timeframe when I've seen everything I need to see and price is already in my higher timeframe points of interest, when it's in an area of higher timeframe value, and that is only then when I will use the M1 or lower for my execution. Because if you're just sitting on the M1 chart all day, you're going to see tens or if not hundreds of entries a day, and you're literally going to get slapped about by the market. You're going to wonder why trades aren't working out or why they're turning around straight away. And it's because the M1 is going to be constantly changing trend every few minutes. So that's why we build the higher time frame narrative, because it's the higher time frame moves, right? Those higher time frame runs and those higher time frame pullbacks. It's those higher time frame phases that I am personally interested in trading, because that's where the high reward to risk is. So I'm just solely using the M1 for increased refinement to get a tight entry and to get a tight stop loss, but also to give me that extra piece of confirmation to make sure as many timeframes as possible are in sync and confirming what I think I'm seeing. So again, for me personally, the 4 hour and the M15 are my most important timeframes when it comes to market structure. So in very, very simple terms, the 4 hour gives me my overall higher time frame bias, and then the M15 shows me sort of the intraday direction that I want to be trading in. Now, we'll get into all of this in even more detail as we go through the rest of the lessons, and specifically in the trade plan module, where we will discuss the different timeframes and the criteria that you may personally want to use for each of those timeframes, depending on your own style, your own trading personality, and whatever lifestyle constraints that you may have. Because of course, some of us may have full-time jobs, some of you may be part-time, some of you may be trading full-time, and that really will depend, okay? But again, we'll get into this in a lot more depth later on. But here's another very simple overview of how you could utilize a set number of timeframes for market structure if perhaps you wanted a slightly more longer-term perspective. Like I was saying, potentially if you have a full-time job, where you can't actively monitor the charts on those very low timeframes. So essentially, you can use the monthly time frame for your high time frame perspective, the daily for your narrative, so seeing if you're trading a daily pullback or if you're trading the daily pro trend run, and then you will use the 4 hour to give you your immediate bias of the direction that you actually want to trade in, before finally dropping down to the M15 to use that for your execution to time your entries with more confirmation and refinement. So make sure you use multiple timeframes to really know the higher time frame narrative, and then actively monitor the lower time frame price action and allow the trade setup to present itself. Now, in the next lesson, we're about to hop on the charts and actually apply all of this theory to real world market examples. But before we do that in a minute, I just want to end this theory lesson on one last example to make this really important point hopefully start to really sink in if it hasn't already. So when we are in a 4 hour bearish trend, the expectation of order flow is for the 4 hour to keep forming lower lows and lower highs, and that is what we are anticipating until we are proven otherwise. But as we now know, in order for the 4 hour to create a new lower high, we need to see a bullish trend form on the lower time frames so that the 4 hour can actually pull back, right? So we will first see that shift in order flow on the lower time frames to switch bullish, which then signals to us that the 4 hour may be now pulling back to form that potential swing lower high. Now, when price eventually pulls back and it returns to our previous 4 hour lower high, because the overall 4 hour trend is bearish and there should be a strong lower high, our expectation is for price to sell off from this area, right? However, it does not have to. Remember, anything can happen in the markets. Anything. So as price develops around this area, our mission is to observe its development and listen to what the market is telling us in a neutral state of mind. So the lower time frame structural development within those higher time frame points of interest, that can really help guide us to be in the flow of the market and execute accordingly and be in harmony with the market. Now, I know sometimes it can be pretty confusing, because on the one hand, I'm saying that we are supposed to be completely neutral in the market, but then on the other hand, at the same time, we do have a trend bias and we have the expectation of order flow. So surely these two things are contradictory, right? How can you be neutral but also have a directional bias and have an expectation of the direction of order flow? Well, this is essentially how you do it. You understand what is the more probable situation, but you are not attached to that outcome having to happen. You don't care either way. You just let the market show you the way and you adapt to what it shows you. So all of the technical analysis tools and the concepts that we use, they are just a mechanical framework to help guide us through the order flow of the market. So as Bruce Lee says, be like water, my friends. Flow with whatever way the market wants to go. Let the lower timeframes give you the confirmation to show you the higher timeframes' true intentions. Don't fight the market from within with your own bias and your own attachments. Master it from above. That is how you evolve toward the light.